Good evening, one and all. Wonderful to see you. My name is Hank Clark. I'm program director of my name is Hank Clark. I'm program coordinator of the Political Economy Project, and it's a great joy to see all of you here this evening on this rainy Hanover day. Today's event is the first in a year-long series whose genesis is as improbable as the genesis of the Political Economy Project itself. One sunny day last spring, yes, Hanover does have them occasionally, one of our colleagues, Russ Muirhead, was teaching a class just outside this building when Professor Meir Kohn happened by, minding his own business innocently. Professor Muirhead waved him over and said something like, "We're discussing X, Y, and Z topics in American economic history. Can you help us out on this point?" And Meir's answer was so lucid, so helpful, and so full that Professor Muirhead immediately hatched the idea of arranging a full series of lectures on the grand topic of understanding the economy. Needless to say, this idea met with the unanimous approval of everyone involved in the PEP circle, and Professor Kohn generously obliged. You can find the full lineup of titles and tentative scheduling through winter and spring term on our website. Now, those of you who are familiar with Professor Kohn will not be surprised by this anecdote. Meir Kohn is professor of economics here at Dartmouth, where he has taught for many years and is widely published in his field. He teaches legendary courses such as Econ 26, Financial Intermediaries and Markets. He helped to found the Political Economy Project itself over a decade ago and has given numerous public talks to the PEP, as well as countless informal reading groups over the years, which have also become legendary in their own way. The second talk in this series is scheduled for 3 weeks from today, October the 17th, at 6 p.m. in this very room, Rocky 2. So, without further ado, won't you please join me in welcoming Professor Meir Kohn.
Thank you, Hank, for that overly kind introduction. Okay, so let me just start by I'm going to thank Hank for organizing this, Russ Muirhead for his idea, George Records, who is sponsoring, an alum who is sponsoring this, and also his general support has made the PEP possible. So he's been a pillar of strength to us. So the series title is Understanding the Economy, and it will not just be, or even mostly be, standard economics. You'll see that I'm quite critical of standard economics, and it's not that standard economics gets it wrong, which on the whole it doesn't. Sometimes it does, and I'll mention cases. But it's limited, okay? There are a lot of very important things that it doesn't really get to, and finance is a good example, okay? So that's a good place to start. All right, is finance theft? Finance doesn't produce anything. What, if anything, does it contribute to our economy? So an antipathy to finance is long-standing, okay? It's a lot of rich people taking a lot of money for doing nothing. Okay, so that's not, generally very popular. What is surprising is that, and there's been particularly a lot of criticism of finance, is the financial crisis and the Great Recession that resulted. But what is notable to me is notable that even economists have expressed concern about what they call financialization, which is the growing size of the finance sector. All these people engaged in finance not doing anything, and they're just shifting money around, okay? So what I want to do is to persuade you that they're wrong and why. So what does finance do? It's a good place to start. Finance facilitates financing, okay? What is financing? And it's providing money to people who want to essentially invest it, okay, who have a use for it. I'll talk about the uses in a minute. And I'll talk about financing business, which is enough for a short talk. But it's also very important in financing households, in things like buying homes and buying cars and paying for their education and things like that. It's also very important in financing governments. Unfortunately, that's been abused a bit lately, so we're going to have some problems with that. But fundamentally, the fact that governments can borrow, it's generally the governments who are able to borrow won the wars. And on the whole, it was the good guys who were able to borrow, so it was very good for the history of recent centuries that governments became able to borrow. But I won't talk more about that. Okay, so the nature of business generally is that you make outlays, spend money today, and you get a payoff only in the future. Okay, and let me give you some examples. One example is what is called working capital. If you're producing things, okay, you need working capital, which means that you have to pay people to make them, and it takes a while before they're sold and you get the money. You have to pay for materials before you sell the product, and so on, okay? Energy costs, all these sorts of things. All of those outlays has to be made before you actually sell the product. So you need financing. There is also what is called fixed capital, which is machinery, buildings, computers, all these sorts of things that you need to buy to use, and you use them for many years, but they increase your productivity, but you don't have the cash yet, okay? And then the final thing, which is relatively recent, is something called intangible capital, which is things like investing in R&D, in new ways of organizing business, like Amazon, for example, training people, all these sorts of things. These are all investments, outlays that you have to pay for before you get the results, and you can't do any of these things if you don't have the money. Okay. And if you don't have enough money of your own, which is generally the case, you need financing. Someone else has to provide the money, and you have to pay them back later, to a large extent out of the proceeds of the investments that you've made. Okay, so that's the way it works. Why would someone provide financing? Okay, so we need it. Why would someone provide it? The reason is you get back more than you provide. Okay, there's a return. And okay, so finance facilitates financing. Why do we need to facilitate? What's the problem? Okay. The problem is very simple. When you're providing financing, you're giving money in exchange for promises. You can see the problem. Promises aren't always kept, okay? So, there's two types of promise. One very simple promise is called debt. It's debt financing, where you're promised specific sums of money in the future that pay back what you gave plus some return, okay? And there's another kind of promise that is vaguer, which is equity financing. Okay, so you provide a business with equity financing. In exchange, you get a share of the profits. Okay, and that's problematic in all kinds of ways that we don't really have to go into, but it's less well defined. What you're getting back is based on hopes more than anything else, okay? All right, so the basic problem is that the recipient of the financing may not keep the promise. And there's two possible reasons. One is that they cannot, and that's the more common reason, okay? And the second reason is that they will not, okay, that they don't want to. And the protection for cannot is information on their ability to pay back the money, okay? And an additional protection is if there's some sort of collateral. So like when you borrow to buy a house, the house is collateral for the loan. So if you don't pay it back, they check if you have enough income to make the payments. But if things go wrong, they can take the house, sell that, and get their money back, okay? The protection for will not is information on their past behavior. What's their record like? What's their credit rating record, whatever we call it. If they've always paid in the past, that's encouraging, okay? And the other thing that helps if they have incentives. If there's a cost to them of not paying back the money, of not keeping their promise. So how big a problem this all is depends on the type of financing, and there's two types that are worth distinguishing. One is relationship financing, which is that the person providing the financing has some sort of relationship with the recipient. So obviously friends and family, yeah, the incentives to pay back are pretty clear in that case, right? But also business relationships. So Walmart has a lot of suppliers in Asia, which it provides loans to, financing to. Amazon provides loans to the merchants who use it as a platform. Not so much in the US, but in some other countries quite a lot. Quite in India, it's very important. They have good information. So look at Amazon. They have very good information on the business because they see all of the sales, you know, what's coming in and how much they're making. And the incentive is very clear. If they don't pay, they're out, okay? And they won't be able to use the platform. So relationship financing works pretty well for these reasons. And on the whole, it doesn't need facilitation. Okay, there's a huge amount of relationship financing going on in the world without finance playing any role. Okay, and it's sometimes called alternative finance, which is not finance. So the second kind of financing in terms of the source is financing by strangers. And if you think about that, that's bizarre. Why would you trust a stranger with your money, okay? And the reason is finance will make it a fairly safe bet for you. That's one of the big things that financing does, okay? So addressing the problems with a stranger is much harder. Okay, we said it's how it works in a relationship. With a stranger, you have to get the information. With a relationship, you already have the information. You don't need any special effort, you have it. With a stranger, you know nothing about them, so you've got to gather the information. The incentives we talked about don't really exist, so that you have to somehow think of creating them. You know, what kind of incentives can we create? Another problem is that these costs are, first of all, significant, but they don't depend much on the size of the loan. Okay, a small loan has pretty much the same costs in these terms as a big loan, which means you're not going to do small loans like this. It's just not worth it. The costs are too large. And generally, it's much more attractive to lend smaller amounts than larger amounts. So that's a big obstacle. Okay. And all right, so finance makes it possible to provide financing to strangers, or for strangers to provide financing. That's what it does, okay? And we'll see why that's such a big thing. But first of all, let's see how finance does it. What's the trick? And there's sort of two main ways that finance does it. One is using intermediaries, and the other is using financial markets. So with intermediaries, we'll use a bank as an example. Okay, you have $100 that you're willing to lend to someone to provide financing. No way you can do it on your own, but yeah, you trust the bank with your $100. It helps now that there's deposit insurance, but actually it's not necessary. Large banks are very safe. They have reputations that they want to protect. They have incentives to pay, and that's good, okay? So you don't have any trouble lending your money to the bank. You don't have to do a lot of homework. And it works for small amounts perfectly well, okay? So that's part of the way, okay? So we get the money to a bank, and then the bank lends it to the ultimate recipient of the financing, okay? And he'll take your 100 and lots of other hundreds from other people, bunch it together and make a loan that's worthwhile to a business. And the bank is a relationship lender, okay? The borrower has incentives, okay? For example, if it doesn't or is late, it's not going to get any more money from the bank. And most borrowers need to continue to borrow. It's not a one-time thing. So that's how we solve the problem, okay? The strangers funnel their money through a financial intermediary. The financial intermediary generally is a relationship lender and does the homework, does the work, and takes a payment for it, okay? So the second way of doing it is through a financial market. So take the bond market as an example. So here, you don't lend your money to an intermediary. You lend it directly to the recipients of the financing. You buy their bonds, okay? And that's financing, that's a loan. And you do it, though, not on your own, but with the help of the financial market. So first of all, there are what are called underwriters that sell the bonds initially to the public, okay? And they do all the homework, and they assure you that this is okay, and they tell you how safe it is. They're specific. They sort of rate how safe it is. So you can buy a few bonds, and because it's done in this way, you don't have to worry too much, especially if it's not a very large amount of money, and you can buy lots of different bonds of different companies. But for this to work, it really only works with borrowers that are very safe. Okay, you need to have a very good credit rating to be able to sell bonds like that and people buy them. But finance has found a way to get people who are not so safe to sell bonds, okay? It's called junk bonds, okay? Bit of a joke, but it's not actually junk. What is the trick? The trick is that there is somebody who provides the relationship services, okay? There's a financial institution, it's usually actually the underwriter of the issue, who continues a relationship with the borrower, and if there's problems, he deals with that. So if you're an investor, you don't have to worry. It'll all be taken care of for you. And there's more chance that you won't get your money back, but you get a higher return. So there's a trade-off. You can make your decision. Okay, so both intermediaries and markets address another problem of financing, or they do something that makes it much more attractive. They provide liquidity. Okay, so if you're going to provide financing to somebody, they need to have the money for a known period of time. Often it's a fairly long period of time. Sometimes it's shorter. But they need to know how long they have the money for and when they have to repay it. As a provider, you would really like to be able to get your money back whenever you need it or whenever you want to. Okay? And finance makes that possible. Finance creates the liquidity. So with the bank, you put your money in a checking deposit. Okay? You can take it out 5 minutes later. You can take it whenever you want it. What do you do in the bond market? Well, in the bond market, you can sell it to somebody else in exchange for cash now. And there's an organized market, that an exchange or dealers who will facilitate this. And so finance provides liquidity. And because for the people who are providing the money, they have liquidity, they're more ready to provide it, which means there'll be more of it available, and it'll also be cheaper. They're willing to take a lower return if they can get their money at short notice. Okay, so that's something else that finance does. Okay, why does facilitation matter? What does finance do for the economy? What justifies all those resources devoted to it? So here we look at standard economics, and it will tell you that finance allocates savings to the most productive investments. That's what markets do. They allocate resources. So finance is an example of a market, and it allocates savings. They go to the most worthy and highest return. They go to the highest return investments because they can offer more, a higher return, okay? Certainly there is something to that. That is kind of one of the things that finance does. But it's interesting, the economics, we'll come back to this, is silent about how the heck it does that. Okay, and we'll come back to that at the end. But also finance does a lot more than this. Okay, because finance makes possible financing by strangers, there's a hell of a lot more financing available. Okay, and the result is for businesses, it's easier to get financing than it would be without finance being there. They can get more financing than they could for a particular project than they would otherwise, and it's cheaper because there's just more financing available. And you see this when in sort of comparisons over time and across countries. So over time, I've studied financial Europe, I've studied, pre-industrial Europe and pre-industrial China. Pre-industrial Europe, there was sort of a steady development of finance over the centuries. And as a result, interest rates came down. Pre-industrial China, that didn't happen. There wasn't much development of finance, and interest rates stayed pretty much the same for centuries, high. Okay. One example of the ill effects, when in the 19th century, China got access to the technology of the Industrial Revolution, they didn't use it. Because using that technology required investment. Interest rates were so high, it wasn't worth it. Okay, so it was a long time before they got around to using these miraculous new technologies because they didn't have the financing. That was because finance was very slow to develop there. The same thing if you look across countries. The US has a very well-developed financial system, but most developing countries don't. So financing is scarcer and much more expensive in developing countries, and this affects their investment. There's a colleague of mine who did a study about technological progress in developing countries, and economists tend to think about the key to technological progress is invention. Okay, no, it's necessary, but it's not sufficient. Okay, it starts to affect the economy when people actually adopt the technology. And as we've just seen, adopting the technology generally involves financing. And developing countries, they have access to a lot of good technology from the developed countries, but they don't use it because it's like China in the Industrial Revolution. Okay, given the cost of financing, it's not worth it. Okay. So another benefit, another thing that finance does is by channeling savings into financing, the savings are more productive. So in the past and in today's developing countries, there's a lot of saving, but most of it does not go into productive investment. It goes into, in the developing countries, a lot of it goes into precious metals. A lot of it goes into building up your herd of cattle more than you actually need for agriculture. Okay, so investing sort of in real assets that you can see and control rather than giving your money to someone who could make much better use of it. So saving is used more productively. And this is good for the economy, but it's also good for savers, okay? Because savers get a better return, okay? Investing in sort of real things like gold and whatever, you can do well if gold is going up. You can do badly if gold is going down, but you don't get sort of a steady return in the way that you do if you can invest in financial assets. Okay, so it also benefits savers. So the next thing I want to do is to look at venture capital in a little bit more detail as an example of how finance facilitates financing and how it benefits the economy. Okay? I knew there was a reason I brought this. Okay. So venture capital is a kind of finance. And why do we need this new thing, venture capital? It was necessary because tech startups are just not suited to the standard kinds of finance. Okay. Bank loans, no. Bond markets, no. Any kind of debt is a problem because most tech startups fail. Okay, that's sort of known. It's a low probability of success, but some of them are spectacularly successful. If you lend to them, okay, the best that can happen is they pay back your money, okay, which mostly they don't. But if they do spectacularly well, you won't get any more if it's debt. So what you need is equity. Okay, with equity, you share in the upside. Okay, okay, well, we have a public equity market. Why isn't that good for startups? Well, the cost of raising financing in the public equity market is large and indivisible. Tech startups usually start off needing relatively small amounts of money. So it would be prohibitively expensive. And so the amounts are too small, typically. And the public equity market is kind of an arm's length market, not relationship. Okay, you buy the equity, it sits in your portfolio, and you cross your fingers, but you don't actually do anything. There's no relationship. Particularly in the US. In some other countries, it's different. It's not a good idea, even for regular equity. And for tech startups, it's crazy. You can't just give them the money and forget about it. You need to keep an eye. You need to provide them with advice if you can. They need help with things. Very often they have fabulous ideas, but they don't know much about business, for example. There is a non-finance way of doing this, and it's called angel investing. Okay, there are wealthy individuals who will invest in tech startups, okay, directly. And unlike sort of standard finance, rather than spreadsheets and this and that and the other, they use just judgment. Okay, they interview, talk to, get to know the entrepreneur who wants to do the startup, and they decide, is this a bet worth taking? And they're not looking for things that are safe. They're looking for things that, if they succeed, will make a bunch of money. Okay, but that's a judgment call. Okay, and it's relationship financing. They don't just hand over the money and cross their fingers. They're involved in the startup. They provide advice. Certain things they have to approve before the money is spent. They don't give all the money at once. Okay, they give it in chunks as it becomes necessary and as it becomes clear that it makes sense to do that. So this is relationship financing. So angel investing isn't finance, it's direct investing by an investor. But the problem with that is there isn't much of it. Okay, so if we had to rely on angel investing, then you know, the startup miracle that we've had in the US wouldn't have happened. Okay. Finance came up with a solution. Okay, finance, you know, one of the things it does is it solves problems. Okay, we think of new forms of finance that solve problems that the old forms of finance don't address. And the solution they came up with is essentially the financial institution will be the angel investor, and the angel investor would raise funds from strangers. Okay, so the angel investor would do all the stuff that we said, you know, the VC, it's called the general partners, the VC institution, okay? They behave much like an angel investor, but they lend not, and they have to lend their own money, that's part of the deal. But they don't just lend their own or provide their own money, they provide money from strangers, okay? And the strangers are called limited partners. So it's by combining someone who does all the relationship stuff of an angel investor with lots of strangers who are willing to put their money into it. And we now have tons of money for startups, okay? And who are these limited partners? So they are also wealthy individuals, but these are wealthy individuals who don't want a full-time occupation as an angel investor. They just want to put their money somewhere where it'll earn a good return. And they can do that with venture capital, plus institutional investors of different kinds, pension funds, insurance companies, life insurance companies, college endowments. You know, all of these are limited partners in venture capital, not people like you or me, unless you're fabulously rich, okay, which I'm not, because usually the minimum amount that they're interested in is fairly large, and you know, ordinary folk don't have that. And the other is it's not very liquid. Okay? You have to commit your money for a fairly long time, and you can't really get it back or sell it to someone else. But still, okay, there's still a ton of money willing to go into venture capital as limited partners. And the result of adding strangers is much more financing for startups and much lower cost. Okay, so that's the benefit. What does this do for the economy? Okay, so that's nice for the startups. Well, the US advantage in venture capital, there are other countries that have it, but it's nowhere as well developed. It started in the US. Very few places come close. So our advantage in venture capital has been a big factor in economic growth of the US economy since the 1980s, okay? And it's grown much more than most advanced countries. Okay, Europe is kind of stagnating, England is kind of stagnating, Japan is kind of stagnating. The US is doing pretty well. And a lot of that comes from businesses that were initially startups that got their start from venture capital. In the period, some statistics, in the period from 1980 to 2020, 40% of new public companies, IPOs, were initially financed by venture capitals, okay, almost half. In 2021, 8 of the 10 biggest firms in the world by market value had their origins in venture capital. The list includes, well, the list is, there's only 8, there's 8, Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, Tencent, and Alibaba in China. And the firms initially financed by venture capital, like the ones I've mentioned and many others, have an enormous effect in increasing employment, creating jobs. So they provide new jobs at a rate 10 times higher than firms that didn't start in venture capital. So they're growing really fast, as we've seen with those are examples, but others too. They've also made a huge contribution to technological progress. They account for about 40% of the total market value, but nearly 60% of R&D spending. So with VC as an example, it's made a huge difference to the US economy. So the bottom line is finance isn't theft, it more than earns its rewards. Okay, so the people who started venture capital partnerships made a lot of money, but they deserve it. Okay, they did a huge amount of good to us. Okay, let me just finish up. I'm actually taking less time than I thought, so that's okay, you won't mind. I think I'm still getting the message across. So I want to connect this talk to the series as a whole, okay? Finance is a form of commerce. Commerce facilitates exchange of all kinds, different kinds, okay? So Walmart is commerce, Amazon is commerce, oil dealers, wholesale dealers is commerce, all these kinds of things. So what they do is they facilitate exchange, okay? Financing is one kind of exchange which finance does, but there are many other kinds of exchange, and they're facilitated by different branches of commerce. Economics almost completely ignores commerce. So there's a lot of talk in economics about the market, but in standard economics, the market is a disembodied spirit. Okay, we don't talk about what is the market, who creates it, how does it work. Not nobody, okay, but on the whole, okay, if you take your basic economics classes, that will never be mentioned. The market does this, the market does that. Who is the market? How does it work? Don't talk about it. And this disembodied spirit magically sets prices and allocates resources. That's what the market does. But in reality, it's commerce that creates the market and operates the market. And it's an economic activity, just like producing textiles, okay? And the number of people employed in commerce as an economic activity is today quite a bit larger than those employed in production. It's a very big part of the economy. So you think we'd be more interested in what's going on there. And as with finance, commerce does much more than allocate resources. And as we've seen with finance, the other things are no less important. Okay, it's nice that finance shifts financing towards more productive investments. But the fact that it creates tons more financing is perhaps more important to the total effect. So economists can lament financialization because they don't really understand commerce. And essentially what they're saying is, why waste resources on something that can be done costlessly by a disembodied spirit? Yeah, well, it's already taken care of. Why do we need to waste resources? In economics, there's another disembodied spirit. There are two, not just one. Okay, so the market is one, and the other is government. Government is also a disembodied spirit in economics, and it's a kind of fairy godmother. Okay, if you have a problem, you just rub your magic lamp or your magic ring, and the fairy godmother shows up and fixes it. That's government. That isn't the government I hear about, but anyhow. So for a more realistic understanding of government, we have a bit of an understanding of commerce. For a more realistic understanding of government, come to the next talk. Oh, okay, thank you. I would be happy to take questions. Yeah.
If you have a question, please raise your hand and I'll get this microphone to you.
I guess I answered them all.
I know you said earlier that finance helped initially with transactions to allow, companies to grow in ways that they wouldn't initially. But do you think in today's day, the primary function of finance is, and the primary benefit to society is through venture capital and through the growth of new technology that venture capital helps facilitate?
No, I think classical old-fashioned finance is still very important. Okay, I mean, we didn't talk about it, but if you want to buy a car, you don't go to a venture capitalist. Okay, and that's a big chunk. And buying housing is a big chunk of the financial system. Government debt is a big chunk, is a too big chunk of the financial system. So there's still a lot for it. It's not that venture capital has taken over, it's an addition. It does things that the classical finance couldn't do, and that's very important and very beneficial, but still the old-fashioned finance is doing important work. Yeah.
Thank you.
Pleasure.
So would you say that technology is deteriorating finance more, or would you say it's making it more effective?
No, I think it's certainly very useful. I mean, information technology is very important in finance and reduces the cost. So no, I think technology is a plus.
Do you think that, sorry, can I follow up on that? Is that okay?
Sure.
Would you think that things like AI that are developing very rapidly and kind of take out, sometimes people say that it takes out the uncertainty out of certain things like loans and stuff like that, and it makes the asymmetrical information problem even worse, like with insurance companies and stuff.
Yeah.
So would you say that that uncertainty, that like reduction of uncertainty is making the market more effective or less effective?
That's above my pay grade. I mean, we really don't know what AI is going to do, and what it's good for, and what it's bad for. We'll see. But it's very unknown. People tend to overestimate the things that it can do, and they tend to overestimate the bad things that it can do as well. So, but we don't know. I mean, we just have to wait and see.
Thank you.
Yeah, I know you said that the United States has a large advantage when it comes to venture capital.
Yes.
What are the reasons you think that the U.S. has that advantage, and I guess on the other hand, why other countries haven't caught up yet?
Freedom. China was doing really well. China was maybe the second in venture capital in the world. They had tremendous benefits from it. And then the Communist Party decided this is a threat to our power, and they kind of squashed it down. Good luck with that. So, yeah.
I'm just curious, do you think that there's any place where finance goes wrong?
Yeah, of course. I mean,
Where?
I mean, probably lots of places. I don't know. I don't keep a list. Human activity is fallible. They get things wrong. There was the genius who invented subprime mortgages, for example. This was not a good thing, although the government had a big role in that. So we'll get to the government next time. Without the government intervention, there are fewer bad things happening. But with government intervention, there are quite a few. Yeah.
If regular people can have a part in the traditional forms of financing,
Yes.
why is it that only like the ultra wealthy have a part in like venture capital? Why can't that also be accessible to?
Well, I kind of explained there. The minimum amount, there are sort of costs in dealing with the people providing the finance, the venture capital. So they don't want to deal with 1 million limited partners. Okay, so there's sort of a minimum amount. Most of us don't have that minimum amount. Some do, and they participate. And the other thing is most of us care a lot about liquidity. Being able to get our hands on the money if we need it. With venture capital, you have to commit. The usual period is something like 10 years. It's flexible. Sometimes it's a bit more. Sometimes it's a bit less. But an investment where I put my money in and I can't touch it for 10 years does not appeal to me. And it doesn't appeal to us. There is something called a fund of funds, which I sort of looked into. I'm still not sure. The descriptions are a bit vague. But you could think, okay, we could have another level where people put their money into a fund that gathers a lot and puts it into venture capital. But that doesn't, seems like a good idea, but I haven't seen that exists. Funds of funds sounds like that, but I don't think it is.
Because something like Destiny Tech or like other kinds of these like funds like ARC funds, those do try to kind of address that issue with like providing some sort of liquidity to the private markets.
Yeah.
Why is it that those don't seem to be?
I don't know. I mean, it isn't that no one's thought of it. It's difficult, and no one has really figured out how to do it yet. It's not impossible that somebody will figure out how to do it, and someday you'll be able to put your money into venture capital. That's the kind of thing we expect from finance, is overcoming obstacles, right? But no one's found the trick yet for doing that, as far as I know. Okay, we can wish them luck.
I know someone already asked about AI, but I'm curious what you think about cryptocurrencies and whether they will be a legitimate factor in like the financial services sector.
I've never been persuaded. The question is, what can they do better than the more standard things? And I haven't seen examples. I mean, the one obvious thing they can do better is anonymity. So if you're the mafia, it's very useful. But for everybody else, it's not clear what the use cases are. In particular, a particular problem is when you make transactions in cryptocurrency, it's very slow to make that transaction. Okay, you have to update, the whole, you can't do thousands or millions of transactions at once in the way that you can with regular money. That's a big obstacle. So I haven't seen examples. I've been waiting for many years. So I've always been skeptical until I see an example. Oh, this is something that cryptocurrencies can do better. Haven't seen it. There's someone behind you, Hank.
Any other questions?
Why does it matter if whether it's like the Nvidia stock is at 120 or like a 50? So they already have like so much money. It doesn't really matter. So wouldn't that money be spent better, like that $70 data, be spending on building infrastructure?
I'm not understanding what you're saying. I'm sorry.
Or like, so like Nvidia, right? It doesn't manufacture its chips, so it has like low capex requirements, and like regardless whether the stock is at 50 or 120, they still have plenty of money. So like, what's the extra benefit, societal benefit that we get from the Nvidia stock?
Again, that's above my pay grade. I don't do stock valuations.
No, it's like it's not specific to Nvidia. It's like when there's like too much liquidity. That's what I'm asking. Like,
don't know. Maybe that's maybe you could write something on the answer to that question, but I don't know. This back there.
Kind of similar in a sense to my prior question about other forms of finance. Do you think that computer-driven, high-frequency, side of finance, specifically in the markets, is something that has any benefit or any negative, or is it just something that kind of exists?
What are you asking about?
High frequency, like computer-driven trading.
Take Econ 26. I talk about that at some length. It's actually hugely beneficial.
Okay. Yeah, I'm planning on it.
It's hugely beneficial.
Next year.
I mean, basically what it does, I'll give away the secret, is it integrates all the different markets. What high-frequency trading does is really just one thing. It's arbitrage between markets. Okay, so by doing that arbitrage, it turns all these dozens of small markets into one big market. So for example, the US stock market, one of the, at one point, the New York Stock Exchange went down. No one noticed. It didn't make a blind bit of difference, because there's now one huge market made up of all these little markets that operated perfectly well for a while without the New York Stock Exchange. So that's really good. And it's hugely competitive. So you can't say they're earning too much from doing this, okay, because they're competing frantically with each other to get there first, to get them, I don't know, a millisecond or a microsecond faster. Yeah, no, it's very beneficial. That's really, really good. Again, I think a lot of the objection to these things, people don't understand. What is it doing? Okay, but if you understand what it's doing, then great. Yeah, come up with more ideas like that. That's really good. Yes?
Thank you.
Should we make this the last? Or maybe that was the last.
Time for one last question. Anyone want to take it?
Over here.
So I have a question about you mentioned a few times in the lecture about how sometimes there's concerns about financialization, or maybe that growth of the finance sector is too much.
Yes.
And I'm curious, could it be too much? Is there a point where maybe the finance sector...
I guess the economics answer is if it was too much, the returns would be too low. People would quit. People would get out.
Okay.
If they're earning a good return, they must be doing something. Yeah, okay. That's sort of that's standard economics. Yeah.
Okay.
Thanks very much, Professor Kohn. Thanks very much.